Okay, so it's 8 o'clock. I'm going to go ahead and start a little bit. When this project was brought to me, it was exciting. I thought there was a lot of opportunity, but one of the things that I always worried about, am I going to have anything to talk about every week? So last Friday when I got off, I thought first thing in my mind is, what am I going to talk about next Friday? And then we had this week, and this week has been just full of stuff from the market. And our job here is what we want to do is kind of share insights on the market. What's going on? What do we see? What kind of things do we consider? And I think last Friday we ended at 8:22, and by 8:45, I already had a long list. So we're going to talk about a couple of things. We're going to talk about the R word. We're going to talk about, I have had a couple questions about a specific stock, and this is not the venue to do solicitations to buy or sell securities, but this is an interesting question. And then we'll talk a little bit maybe about COVID, and we'll talk about the future as far as the Federal Open Market Committee is concerned. And we're going to start with unemployment. So last week we talked about unemployment being having this great big number pop up on Friday morning, and everybody was excited, and it was actually kind of an anomaly. We were expecting an increase of 2 to 2.5 million jobs being lost, and instead we saw just the opposite. By noon, we knew that that number was wrong. Something had happened. And there's an anomaly with the numbers. It'll be adjusted later, but it was a big anomaly. This was not an addition mistake. This was a really big mistake. So what we do is we want to step back and look at it. It isn't that number that's specific. Let's not forget the fact that unemployment is still upwards of 10%, upwards of 13%, and possibly will approach 20%. So we don't want to get hung up on last Friday's number. We don't want to get hung up on what they adjusted to. What we want to pay attention to is where's unemployment? Unemployment is high, and how will it come back? We don't really know. We know that it'll come back in different sectors in different manners, but before we get excited about that single number, our point is let's just step back and look at the forest and see where we are. We have a lot of folks out of jobs. That goes into the R word, which is recession. We officially entered a recession this week. The recession used to be judged on a different manner. It was judged on consecutive quarters with a downturn in the gross domestic product. It's now defined, it started in 1974, as a decline of 1.5% on year versus year of the gross domestic product. So in late December, early January, the government had predicted that the GDP would decline about 4 to 4.5%. And instead that number came in at 5% down, which is not good at all. And on top of that, we have what we just talked about, which is unemployment. So with the GDP being 1.5% down year over year, and unemployment being 6% or greater, you are officially in a recession. So we actually entered a recession in second or third week of February. And then the question is, how long will a recession last? And being a history student, a student of economics, you can go back to 1854, and in all those years, there's been 33 recessions and 1 depression. So that means we have this economic downturn about, on the average, every 5 years. The good part to look at is, while we're now in a recession, this follows 128 months of growth, going back to March of 2009, when the Dow Jones Industrial Average was at 6,600 at the end of that month, and now we're pushing 27,000 again. We're at 26. So that's pretty incredible growth over 10 years. And the downturn wasn't unexpected on our side. What was unexpected is the cause for the downturn. Nobody could have foreseen that it would be caused by a virus. In 2008, we had the big thing was caused on the financial side. So the point is, since 1854, as long as we've kept these records, we've had a recession on average about every 5 years. We've got 10 years without one. It's not unexpected. Then the next question is, how long will this last? And this week in the notes from the Federal Reserve, which they publish 8 times a year, their notes are indicating that they're foreseeing in 2020 about a negative 6%. That's not great news. It's actually also not terrible news. And as far as length is concerned, they're saying they think that rates will be at 0, which is where they are now, 0 to 0.25%, until 2022. So they're kind of indicating to us that this recession could be a little bit long lasted. and we need to prepare for that. So when we're doing our portfolio management, that's kind of what we're looking at. We're not taking chances. We're not buying things that are just the spur of the moment. Hey, this is going to work now because it's COVID, because it's affecting COVID. And there are a couple of great companies out there that we can talk about. We're looking for companies that, from our point of view, that not only will survive this, but will thrive afterwards. That's our goal. And when we look at the market, we look at what it's doing, we look at the economics, we're not looking for a quick return. We're looking for companies that are well established. So, and again, to repeat, this is not a solicitation to buy or sell securities, but one of the securities that's come up this week, I've got a lot of questions on, is Hertz, the car rental company. So Hertz files bankruptcy, and they have been one of the hottest selling stocks in the last 10, 14 days in history, driven mostly by a little app called Robinhood that people can put on their phones, and they can go in and buy the stock. And so people have been going in and buying Hertz. Now, I've gotten a couple of questions. Is this a good buy? You got to keep in mind a couple of things. Number one is they filed bankruptcy. So they have a couple of problems. They have $14 billion in inventory in automobiles that right now are sitting in parking lots all across the world. They have about $6 billion in corporate debt. And with their price per share at the close last night, they have a capitalization of about $250 million. So it might be a fun play, but it's not something that we're going to go out and buy because it's cheap. And but it is one of the hottest selling stocks right now, and it's fun. I suppose there's a lot of young kids buying into it, but it's not something where you can look at and go and ignore the fact that the company's filed bankruptcy. So those are not deals that we're looking for. We don't want to buy those kind of deals at all. Mallory, if you put up the COVID chart, and that reminds me, today I'm being assisted. Mallory is our producer, Mallory Vaughn. She's our marketing director here at the bank, and she's being assisted by Lexi Smale, who is our operations and portfolio assistant. So this chart is our COVID chart, which we showed a couple times before. The blue line is the daily movement of the Dow Jones Industrial Average. The red line is the 7-day average. The green line is the 14-day average. Now, from a technical point of view, you obviously, your daily number, you really want to see it above the moving average. And that happened a little bit. We had a little bit of a growth pattern. You can see that our recovery since March 23rd is actually about 30%. We had a pretty solid, 6 weeks. But here we go in the last 3-4 days where we're now below the moving averages. So what's going to happen? Mathematically, it's impossible not to happen, is next week, those moving average lines, they're also going to dip. And now it's a matter of how far will the market go. Today, we may be up a little bit, probably won't be more than 250 points or so. And what we're looking for is some stability in the market. We're not sure we're going to see it. A lot of things are happening. We have 3 companies reporting some potential COVID virus relief, and that's great if they find it, but we're still looking at the first 2 months of next year before they're able to get that out to the masses and protect us a little bit. So as far as insight on what's going on, we talk about a W recovery. This was starting to look more like a Nike swoosh recovery, and now it's starting to look more like it might be a lazy W recovery. And here's the great part about economics, is we can tell you why something happened, but we can't really tell you what's going to happen. So we can look at it now and see what we have going, what it might be looking at, what we're kind of being careful of. But from our desk, we're looking at being pretty cautious at least through July. And then depending on what happens, we think there may be another possibility of a downturn in October, November, and we're positioning ourselves for both of those. It's the smarter thing to do. The problem with us from market insights, and when you're looking at where do we go, how do we invest our money, right now, as I said, FOMC interest rates are down to 0% to 0.25%. Mortgages are at all-time low; they're below 3%. So the hard thing for us to do is to find return on cash investments or cash equivalent investments, and those returns are dwindling because of the interest rates. So this week there was a lot to talk about. We are concerned about that unemployment figure. It will be adjusted. The thing to remember is to step back and look at the forest. There are a lot of people still at work. And then the fact is we're officially in a recession. We need the GDP to go up. Right now we have auto plants, which are a huge part of GDP. Auto plants are closing. There's a call for another one to close this morning because of COVID cases that's cropped up. The union's asking GM to close the plant. GM wants to keep it open. That debate will go on for a couple of days. And so what we're still trying to find are bright points. Will this end? My opinion is always to stand back and look at the Dow Jones on the long term. And you can find events, the assassination of John Kennedy, 9/11. You can find those events and they are blurps, but we feel solid that this is going to be back. But we're also thinking that we're looking at probably 2000 solidly into 2021 and possibly into 2022. So let's make sure I've gotten all my questions. Let's see, am I still wary of travel and leisure? Mallory, can you put that airline chart up for me, please? People got excited earlier this week about travel and leisure, and we started seeing a lot of money going to the airlines. And this is the airline chart. You can see all those different color airlines are different airlines that we follow, and you can see where they all took a dive, and then they all leveled out, and they all had this little bitty pickup. But they're pretty much leveling out where they are now. They're starting to bring airplanes back online. Hotels are starting to rent rooms, but they're being very careful about how to do that. Casinos are opening up. That's going to be a big factor to see what happens in Vegas over the next 30 days. They're opening casinos. How do you practice social distancing in a casino? How do you practice social distancing at the shows? And so the answer to the question, am I still wary of travel and leisure? The answer is yes. I'm not creating any new positions in that sector right now, and probably won't for months. But when I look at this long-term chart for airlines, I don't see a lot there that excites me. I do see a bump in Boeing, and I see a bump in Airbus, mostly because they may go back to delivering airplanes. That's great. But again, I think that's just a cursory bump right now, and that could go back down. So it is, we are at about 8:12, about out of time, and I think I've addressed all the questions we had online. We are officially in recession. Raising interest rates, that question came in. It's the Fed came out this week. They're not going to raise interest rates. And as I said earlier, their opinion and their feeling is that over the next year, we're looking at probably a negative 6% growth. So the likelihood that interest rates are going to go anywhere is extremely remote right now. We don't think they're going to be raising anything. It's the Fed ideally wants those interest rates about 3.25%. There's a lot of deep economic reasons why you want interest rates high and where you want inflation to be a reasonable number, and that's to keep up with a lot of things. It's a long-term plan, but right now the 0 to 0.25% is probably where we're going to be on interest rates for 12 to 18 months. And now we're back to in portfolios when we're doing design and when we're trying to plan what we want to put in. That's one of our concerns is how we find a return when cash is really not producing too much. So that's it for this week. We're going to be back next Friday. We will not be here on July the 3rd. The market is closed. That's 2 weeks from today. We will be in the office, but market's closed. We won't be online. So remember, send any questions you have this week. We'll put it on the show next week and add it to the list and make sure you get covered. If it's a question about securities or a question that's relative to your account specifically, we'll contact you directly and answer the question for you. So I see some great names out there. It's really awesome to see all these folks that have joined, friends, family, clients. It's really great to see everybody. We really appreciate it. We're enjoying doing this, and we hope to see you again. Thanks for coming. Have a great day.